And welcome to PM Express. Let's have a big conversation about a report that was launched last week by the Statistical Service. And it's really very simple when you look at that report and its implication on this economy. As you know, we've been talking quite a lot about the falling cedi. But if you look at Ghana's trade vulnerability, you see that relationship between the rise of the imports and the fall of the cedi. And that is exactly what we're going to be exploring here today. It is really the biggest conversation we must have on the back of that report. Because as you know, over the years, the fundamental solution to the challenge with the cedi's depreciation is to change the structure of the economy to one that is more export-driven than import-driven. And we have heard this repeated across our history. The Georgesburg economy must be torn apart. So we build in this place an economy that exports more than imports. And so when you see the latest trade vulnerability report, that shows that we've imported $100 million more. If you compare this first quarter to the same quarter last year, then that begins to raise alarm bells, especially when you consider that the cedi is in a free fall again. It's stabilized somewhat, but it is still falling. And you need to ask that question when you look at that number. And this is why we need to have this conversation today. What is the government doing to reverse this? And government will tell you that one of the reasons why they introduced the one district, one factory was so we can manufacture more, and so we export more than we import. So we will reduce this figure that you have on your screen. But then there is also a very interesting irony, some paradox that we also begin to see in the numbers that we are beginning to look at. But still, this is just to track the trend over the period, looking at the first quarter imports from 2021 to 2024. And you begin to see the picture that I showed you. We isolated 100 million, but you see that in 2022 first quarter, you see that we had 4.8 billion. That's huge, right? And then you come to 3.8 billion, and then we're talking about 3.9 billion. Those are jaw-dropping numbers. We're kind of this poor. We're putting a lot of money in importing quite substantially. And as you've seen from last year to this year, the graph is inching up, mounting to $100 million of imports, more than we did last year. Now, that is a figure there. You look at the trade balance, and this is where the irony is. So we're looking at a 2023, where we have a trade balance of 5.3 billion cedis. That is actually positive. You're going to see when I started to break it down further, that you have a trade surplus. In essence, that when you look at the picture, we are exporting more than we're importing, right? But that doesn't tell the whole picture. And that is why we need to have a conversation. Because some can look at the number and tell a story about we're doing well. But if we are, why is that not reflecting on the economic fundamentals? So then you begin to look at this number and begin to now unpack why that is the case. If you compare to 2022, you have this negative 4.8 billion. That tells you that you know the trade balance was in a negative, right? Let's break that down a bit more. And this is the picture. So we are talking about trade surpluses over the period, right? And if you look at the 2023 picture, for example, we now look, the red bar you see there is the imports, the blue bar is the exports. And if you look at the picture there, in 2023, if you look at just that, the difference between the two, it's pretty slim. But the important point to note is that we were exporting more, 16.8 billion USD, compared to how much we were importing, the 16.3 billion, right? So that should be good. But the fundamental question we need to ask, which I asked earlier, is that if that is the case, why are we not seeing it reflect in the fundamentals that then will, of course, show up the cedi and show up our reserves locally? Because then we are exporting more. You need to be earning a bit more foreign currency, foreign reserves for yourself. And you see the picture there again in 2020. That's the time when I showed you earlier, when that trade, we didn't have that surplus, where we have the trade deficit there, because in that particular year, we exported less than we imported, which is what you've seen there. And so that dynamics there wasn't good for us. As you see that the exports was less than we had. But when you come to 2023 again, if you look at that same period, we're looking at that picture again emerge in terms of what we are. So these pictures are important. And then you begin to now look at the holistic percentages. Exports, if you 2022 to 2023, we're looking at 29.3% exports and imports of 21.6%. And you look at this and you say, well, again, that is good, right? Because we are, in essence, exporting more than we are importing. We'll need to ask that question when my guests sit to explore this subject a bit more. What are the nuances that leads to the picture that you have on your screen? Well, what is it? That although we are exporting more than we are importing, as the picture there shows on your screen, that difference of 7.7%, which is really a surplus, a plus for us, why are we not seeing the corresponding impact? When you begin to drill down what exactly we are exporting, then you understand why they may necessarily not be the impact that you expect when you have a trade surplus. Because a lot of the things that we export, almost all, that accounts for that surplus, are commodities. Commodities that we are not adding value to. Is when you add value, then you derive the best from your commodities and what you export, right? Don't just add value with intention of exporting. And you see the huge amounts of gold that we're exporting. Huge. We're not adding much value to that. So with the minerals that we produce in this country, the oil that we produce, and then cocoa beans. Then there's a small amount of cocoa products that we process, but largely we're exporting the cocoa beans in this very raw form. Even that, we've already hedged it, right? And so when, for example, early this year when cocoa prices have gone through the roof, we're not benefiting because we've already said we're going to go for the cocoa syndicated loan. So that tells a story. Now, what happens when the gold goes and the oil goes? The companies behind this, most of them, the huge companies, they aren't Ghanaian. So when the dollar comes in, it goes out. They have to repatriate the dollars that you're making. So a tiny minority of that amount, just a small fraction, will stay locally. And so yes, you have a trade surplus, but it's not really coming in here to show up your city. We'll try and unpack this more when we get my guests to sit and look at this, because we need to really unpack this to try and solve this particular problem that we are facing. And don't get it twisted. The issue about the city depreciation affects all of us. It's the reason why cost of living will go up, and it's going up, right? If you address it fundamentally at this level, then we begin to solve the problem. And you see the mineral products are telling us a story there of we produce in this country oil, and so we're exporting that, which is good. But how much value are we adding to that, what we produce? We also bring in quite a significant amount of crude also into this country. And we did an analysis on PMX a while back to show you just the sheer amount of money we will need just to import finished products in this country, $400 million a month when it comes to finished petroleum products. And this is the latest list when it comes to the countries that we're dealing with in terms of the countries we're importing with the top 5. China there, Netherlands, and Russia has come in very strongly. Why is Russia there? Russia is there primarily because of the crude oil imports. I'm pretty sure you've seen the report circulating on Bloomberg that we have another Russian tanker sitting offshore after almost a month, more than a month, is just offloading its products into our tanks at all. This is not the first time we've had that. So Russian crude has become cheap because of Ukraine and because the West is beginning to shun it a bit more and all the sanctions. So it's become a bit more cheap. And Ghana is doing quite a lot of business with Russia. And that is why you see Russia in that picture there as number 3. India, USA as well. That is very important to know, right? And I also want to show you the subject of sugars and sugar confectionery. And this is important because then what are the things that we are importing? We built a factory, the Commander Sugar Factory, with this in mind. We can produce sugarcane here, but as you know, that factory hasn't really worked. And so we're importing quite a bit of this. And that is why you're seeing this 49 million in this quarter, right? Just in the first quarter alone, that's how much we've imported. It's spending a lot of money to import that. And then you look at the cocoa and cocoa products that, again, we are importing. This one, when I looked at it, fascinated me a bit. Because if you look at just the first quarter, it's $11 million we've spent on bringing in cocoa. And for a country that produces cocoa, to think that we are importing cocoa beans in that significant number, to the point that the first quarter import alone, the amount of money we spent on it, is more than what we imported, what we spent to import for the entire year of 2022 and the entire year of 2021. That's fascinating, is it not? Because in the entire 2022, we imported just $4 million. That's how much we spent, right? And then 2021, $6 million. But then you come to this year, first quarter, we're talking about $11 million. What's happening there? Something is fundamentally wrong, and that is what we need to tackle if we have to deal with the cedi problem. My guest will join me for a conversation here on PM Express after this. Thanks for staying with us here on PM Express. It's always brought to you by Syntex Tanks. It is strong, it is tough. If you want a tank that can store water and last and comes in different shapes and sizes, but also bespoke, you really need to call Syntex Tanks, because they also have 7 years warranty. No other tank in Ghana has that. They are across the country. Pick up your phone and call them. They are 0244 335 168 or shop online at syntexgh.com. You're strong, you're tough. My guest joining me tonight, Professor Godfrey Bokwe is an economist and professor of finance at the University of Ghana Business School. Professor Samuel Kobana Enin will also join us as the government statistician. In fact, we'll be joined by the Statistical Service on this particular matter. Sechuma Kwabwa is the CEO of the Association of Ghana Industries, and Yusuf Suleimana is a ranking member on the Trade and Industry Committee. And I want to really start with Professor Bokwe on this. Prof, how do you explain that paradox of the trade surplus that I've just talked about, that we see every year? We look at this, we're seeing years where we're doing very well. For example, 2023, 5.3 billion cedis when it comes to the surplus we have in terms of the balance there. But you don't see that reflecting in the fundamentals of the economy. What's happening there?
Okay, thank you very much. Good evening, Evans, and then our cherished listeners and co-panelists. Well, that's not strange, Evans. That's not strange. From a more theoretical point of view, one would have expected that with a trade surplus, it should contribute to the strengthening of the local currency. But that is not the end game, actually. And actually, I think if you look at the data, we started recording trade surplus from somewhere 2017, right? So since 2017, we've seen that pattern, trade surplus. But really, it hasn't contributed to the strengthening of the local currency because there are a number of factors, right? So I want to look at it from the balance of payments data point of view. So if you look at the trade surplus, and then you look at the other component of the balance of payment data, especially when it comes to services and income accounts, you see a huge deficit, okay? So at the end of the day, by the time you sum them up, you end up with a negative sum game in terms of current account deficit. That's what happens. The other thing that we should also bear in mind, Evans, is that we are not primarily the owners of the export earnings. We are not. So if you look at, like you rightly said during the introduction, if you look at the major exporting companies, gold, oil, and the rest of them, really, we are not the owners of those export earnings. And what is also happens is that the entire export earnings doesn't get repatriated to the country. So the real effect of that surplus is actually not felt in our economy here. And it's also a reflection of the low local content in our economy. In fact, actually, if you look at the way the Ghana Statistical Service has worked in the last couple of years, and I think we commend them, if you look at the volume of data that they provide, which will guide policy making and implementation, you'll be amazed. Even when it comes to inflation, they go so much into detail, right? Local, imported, regional differences and all of that. So what it means is that if we're mindful as a country, we should be able to use that data to inform policy making and implementation, because some of them will require specific policy interventions to address. So you have the trade data, you have the export data and all of that. But really, I'm not too sure. And of course, we are not really driven by the evidence in terms of evidence-based policy making that will follow through to the very end. So it's not surprising that the trade surplus, we have recorded trade surplus, and yet the cedi continues to depreciate. It's simply because there's a low local content in that export earnings. And then also when you look at the other component of the balance of payment data, services and income accounts, and you take into consideration investment in our economy, because Evans, primarily, what are we saying? We are not the ones investing in this economy. Even when it comes to labor input cost, minimal. You may find a multinational company with so many Ghanaians, but there may be maybe 3 or 4 expatriates that command more than 40% of the wage bill. At the end of the day, it's another form of exiting effects out of the country. You may, when it comes to capital, because savings level in this country is very low, we are primarily not investing in this economy. We are not financing that growth. And therefore, the providers of capital, the return on capital at the end of the day is very huge.
Yeah.
And that also leaves the country. And that is also recorded in the other component of the balance of payment data when it comes to services and income
So
accounts.
those are very interesting thoughts on that subject. I want to bring in Dr. Owusu Keja. He's a Director of Communications and Dissemination at the Ghana Statistical Service. Just on that point, and Doc, what is the Statistical Service's own reflections on that particular paradox between the trade surpluses we record and its potential lack of impact? Not even potential, it's established that it has no impact on the economic fundamentals of the structure of this economy.
Sorry, I think I missed your question.
No, my point is, if you look at the trade surplus that we've recorded over the years, just as we've been explaining there, it does not have any direct impact on our economic fundamentals. For example, we're talking about the cedi's depreciation. We don't see its impact, say, in helping the cedi stabilize. Why is that? From a statistical point of view, why is that?
Thank you, Evans, and good evening to our viewers and colleagues online. I think Prof. Bockton has already talked about the issues affecting the fundamentals. And you notice that this surplus that we are seeing, in the report, we are saying it's not real because it's affected by price changes. And so I don't think this is even sustainable because you notice that in 2022, we recorded trade deficits because of the fundamental problem that we have. And so yes, even though we recorded this surplus in 2023, we realized that this is not something that we can say is sustainable.
Except that that's not the only year you've recorded a surplus. In 2021, you also had a surplus, right? And I'm just curious to know, from the Statistical Service's own point of view, what do you think is accounting for that disconnect between those surpluses and what the economy actually experiences?
No. So again, it's possibly if you look at the volume of trade, then you notice that possibly the products that we were exporting vis-a-vis the product that we were importing account for this differential.
What are you referring to? We're exporting a lot of gold, oil, and cocoa.
Yes, in terms of cocoa, you even notice that in Q1 of 2024, we had challenges with the volume of trade. And so you notice that in previous years, we had huge volumes of tons of cocoa exported. Yeah. But especially if you look at the various months at which we usually will have high volumes of trade. And so every first quarter of the year, you notice that we have an appreciable number of exports in terms of volumes. But you notice that in 2024, there was a slowdown in terms of volumes. And so, yes, you might think that the prices, we are getting a lot in terms of the value that we are getting, but you notice that in terms of volumes, we are not getting much out of that.
I want to bring in Seth Chumakwaba, who is the president of the Ghana Association of Industries, AAGI, into the conversation. And Seth, you know, last year when the Trade Ministry decided to ban the imports of some selected items, one of the items on the list that shocked a lot of people because of just the volumes we were importing in this country was Yemwadie, Ofal, right? And we all saw the numbers that were quite astonished. And you would think that after seeing the numbers and all the controversy that it generated, we would see a decline in the imports of, say, Yemwadie. Let me read to you what the Statistical Service found, though. First quarter of 2023, we imported $45 million worth of meat and offal. This year, same first quarter, we've imported the same, 45 million. So it hasn't changed. We are still importing the same amounts. In fact, if you go to the first quarter of 2022, we imported $68 million worth of Yemwadie. That tells you a story, right? And from the AGI's point of view, if we are to fix this problem, the solution lies with you. In other words, if you were producing a lot more locally, then we would not be importing as much. What's your own reflections on this data? That nothing much has changed. In fact, it's getting worse over the period. First quarter to last year, we've imported $100 million more worth of items.
Well, thank you, Evans. And you are right. Nothing much has changed. It's rather getting worse, and that's where our worry is. And it's not just the last 2 quarters that nothing much has changed. It's over the years. If you look at the whole economy structure, the structure of our economy hasn't changed. Even if you look at the exports, about 3 products for so many years is accounting for almost 80% of our total export revenue. So clearly, the structure of our economy hasn't changed. Same thing applies to imports. Some products, it's quite revealing that products of this nature, which can conveniently be produced in the country, we are still importing so much.
Yep.
The question is, why not? And you're saying, well, production should go up. It's the responsibility of the producers to produce more. But it doesn't work that way. It's a combination of things that must happen for the production to be jacked up. First of all, the economic environment has to be very good. Business environment has to be good. It has to be competitive. If you are borrowing at high cost of interest of over 30%, if you are importing raw materials, basic raw materials, and the duty on it is pegged to the dollar. So when it comes to the port, especially now that the freight is going up, the cost of freight is going up, you are paying more. If you are paying electricity of so much, high price, then it means that your cost of production is high. Unfortunately, access to medium to long-term funding to expand our operations and do large-scale production and enjoy economies of scale, we are unable to do so. So once you are not enjoying economies of scale, there's a limit to which you can reduce your cost per unit, and that affects you. So a combination of things must happen. And you made reference to the minister's efforts early part of the year. Yes, last year to introduce some restrictions. Yes, we supported it, but we supported it not in the sense of encouraging local companies to be uncompetitive and still protect the market for them. We supported it because we knew it was going to be a gradual process of expanding local production to fill the vacuum that is there. So it is how you approach it. And I think in principle, it was a very good policy. We should have worked with it. We couldn't work with it, but we can always revisit it. The most important thing is that even if you do import restriction, if you don't improve the local environment for production, if you're unable to upscale and produce in large volumes and spread your fixed cost over larger units, you will not be competitive. So those factors must be at play and work towards encouraging local production so that we can reduce the imports. As long as we haven't changed the structure, reducing the imports is going to be very difficult. And if you are not reducing the imports, you still have a problem with your cedi, the pressure on your cedi, and your cedi will always depreciate. So these are the concerns.
And you raise a very important point. In terms of restricting imports, you must start somewhere, right? You can do both at the same time, can you not? You're trying to change the structure of the economy, trying to give yourselves the incentives, but at the same time restricting some of the imports.
Exactly the point. I remember one product that featured on that import list, and people raised an alarm. And I thought that that should have rather alerted us that the policy had some approach or goal, and that is sugar. The argument was that we are not producing sugar in this country. Why should you put import restriction on sugar importation? So the question is, if you are not producing sugar and you are restricting imports, in principle, it doesn't make sense, isn't it? Yeah. But the idea is exactly what you have said, that we start gradually. The idea was that let's monitor the volume that is coming in. Let's encourage local producers that indeed, if you go into sugar production and you're able to produce so much volume, we will gradually reduce the imports and we'll take the local production as a substitute. So that was the idea, and it relates to all other products. So you start small and you gradually grow the local production. Once you create market opportunity for the local producers to come in, it will encourage them. Business starts with market. It doesn't start with anything else. If there's market, business people will take advantage of the market and produce to fill it. So I think the effort in that sense was to create the market. But this is not to say that create the market and let the people continue to be uncompetitive or unproductive. That is not it. It's a gradual way of developing it. And I think with a structured arrangement, it is possible to do it.
It is possible to do. And I want to put that to Yusuf Suleimana, who is a ranking member on the Trades Committee in Parliament on the minority side. Your side shut this down last year. This attempt by the Trade Ministry to restrict the imports. You just had the AGI president talk about it is possible. And really, if you are to tackle the problem we've just been discussing, as has been demonstrated by the Trade Vulnerability Report, that's where to start, isn't it?
Evans, good evening, and good evening to our viewers as well as my co-panelists. Indeed, we shut it down. We shut the legislative instrument down because we thought that it wasn't in a good taste. It wasn't in a good position to help us. For instance, if you have a minister who have to solely determine who is given the right to import and who is not given the right to import, we thought that that was problematic. And there were other things that we thought we could have sat with him to iron out before that legislative instrument is even laid. And he didn't reason with us. So he brought it only to realize that he didn't do the right thing. In principle, nobody is saying that it's no good, but we thought that we could have done something better than what he had presented. Now, Evans, let me also talk about the issue of trade surplus and its relationship with a very weak currency that we have. I agree with Prof that because of the dominance of some foreign companies that are dealing or that are handling the major products that gives us this surplus, they repatriate the revenue that they get, and so they leave us with nothing. For instance, if you take the gold industry, how many local companies are in the gold industry? And so whatever that is exported by these foreign companies. And so they find a way of taking back the revenue in its foreign states. And so you leave us with less. Talk about oil. I mean, all the companies in the oil sector, when they also export and bring in the revenue, yes, we just see it. Ghana is used as a conduit, bring in the revenue, and then it goes back. And so on the face of it, you say that, yes, we are getting in more foreign currency, but it doesn't stay here with us. And there are other factors. And I think that those are things that we should look at and look at them very, very well. For instance, we all agree, and Prof is there, that there's a relationship between inflation and exchange rate. So if you have a country with a very high inflation, even when you bring in goods, because there's a high rate of inflation, it affects the purchasing power of the citizenry, of the customers. And once that happens, it reduces demand. And so even when people are willing to buy in more goods, because there's a low demand as a result of inflation, they will have to restrict imports. And so you see import coming down, but of course, export would have been going up. So this could also account for the reason why in 2023, we had more export but less import. Again, look, let's also look at policies of Bank of Ghana. a situation where Bank of Ghana, in my own opinion, is depressing demand for dollar. And take, for instance, in 2023 alone, over $500 million were auctioned to bulk distributors, the oil companies, at the expense of other businesses that were looking for the dollar to also import. And so if you are giving it to only the oil sector at the expense of other businesses, clearly they will not be able to bring in more goods. And so that can also affect our import bill. And so these are some of the things that we should be looking at. And I think that even as you look at the fact that these are companies, that repatriate whatever revenue comes in, there are certain things that government is also doing that doesn't inure to the benefit of us when it comes to our relationship in terms of what we import and what we export.
But Yusuf, let me ask you. Let me ask you fundamentally, though. Let me ask you fundamentally. It is beyond doubt that the ultimate solution is to reduce our imports. It's beyond doubt. If you reduce your imports significantly, really, it becomes an export-led economy. That then reduces the pressure that you see on your currency. The government policy was to restrict the imports. You don't disagree that that is the ultimate solution, do you?
Yeah, so what we are saying is that if government wants to reduce the importation of certain products, what government needs to do, first and foremost, is to ensure that at least we have something to start with. For instance, he's talking about sugar. I disagree with him. The NDC government brought in this sugar factory. For some reasons, we have not been able to produce any sugar. So if you are saying that we should restrict it and that some investors will come in, where are they coming from? Why is that they haven't come to take over what we have started with? And so a product like this, I would disagree with you when you are saying that we should restrict its importation. What you only end up doing is to create monopoly, and prices of such a commodity will go high.
I mean, but our neighboring country, our big brother in the sub-region, Nigeria, has done it with rice. They restricted imports of rice from the rest of the world, and they focused on producing rice locally. And if you speak to any Nigerian, they'll tell you at the beginning it was tough. They had shortages, and people were trying to smuggle rice in, but they kept to it until now. Nigerians eat their locally produced rice. Why can't we start somewhere with this?
Evans, I agree with you to the extent that it was a policy by government and subsidized heavily, okay? In our case, tell us, what policy do you have in place for sugar? What policy do you have in place for rice? And you are talking about restricting them. Government should come out with a policy, a deliberate policy, to say that, look, we are going to support A, B, C, D people who are already in, let's say, rice cultivation. And now we think that in the next 5 years, this is the quantity we are likely to produce. On the basis of that, we want to restrict the importation of rice. Government should tell us that we have a policy document that is inviting investors, come and invest in the sugar industry. And that when you do that, this is the package you have for you. And once you are able to do this and increase sugar production, we are saying that in the next 5 years, this is the quantum of sugar that we think we can produce. And so we want to reduce. Nigeria did not just start without a policy. Nigeria's government came out with a well-intended policy, and that is why today they are able to be on their own when it comes to rice production. Tell us in the case of...
we just the network there isn't helping, but let me bring in Setu Makwaba. We've heard about the government's industrialization agenda, which was fundamentally anchored around the one district, one factory initiative. Tell me, industry, you're in association, obviously some of your members may have benefited from this. Wasn't that the solution as far as government policy? And we've seen the document before Parliament asking for tax waivers for some of these manufacturing companies. And government tells us that is their fundamental policy to create incentives for these industries to thrive. Hasn't that worked? Because Yusuf is talking about incentives, creating an incentive for the local industries to build the capacity to grow a bit more and to produce a bit more. Then we can consume what we produce locally and reduce our dependence on imports. Hasn't this policy worked?
Well, thank you again, Evans. You asked the question, wasn't the introduction of the one district, one factory the solution. I would say it was partially the solution, but it cannot be the entire solution because there are several aspects to industrialization. The essence of the one district, one factory was to target specific products within specific districts and regions and promote its production. And that was a good policy. But beyond that, you also need to have a conducive environment where without government intervention, the factories can survive on their own, do big ticket business, export and expand and make good business. So a combination of this must happen at the same time. The incentives bit is very important. And indeed, the idea of providing incentives to attract investment into some of these areas that hitherto may not be that attractive to the typical private sector operators. So that is important. Another aspect that makes it feasible and very important is the value chains working. If you only set up a factory and you don't have the raw materials provided in a consistent, reliable, and regular manner, you have a problem with the production volumes. And we've experienced this in several sectors and several products. So setting up one district, one factory alone is not enough. The value chains must work. As we speak now, there are some of our big companies that are actually relying on local sourcing of materials, and they don't get adequate supply of it. So sometimes they are even importing. So if you want to have a working one district, one factory, it is good that you have manufacturers that are concentrating on the setting of the factory, but we must have agriculture that is working and producing or farming the products and supplying them at competitive price. So it means the value chains must work. The transportation from the farm gate to the factory must work. The volumes you are producing, it should be commercial agriculture that is not just relying on rain-fed agriculture, but also irrigation, and so many things must work. If you set up only the factory, it will not be the solution. So it's part of it, but not the entire solution. The incentives are important, but as I said, I know the effort Ministry of Agric is making, but I think the linkage between industry and agriculture has not been that strong. I know Ministry of Agric will say, for us, it is food security, that is our core business, which is good, but I think we've reached the point where we have to go beyond that and rather make sure we produce to feed industry. When you do all this and the value chains are working, and then, as I said, macroeconomic environment is good, then the factories on their own, without any government interference or support, they will be able to stand the test of time and become competitive in the environment. So it's a good policy, no doubt about it, but other things must work to make it whole.
And Prof, what's your own verdict on the one district, one factory? We just have 6 months for the government's tenure, and it's a good time to assess it because it was introduced as part of the solution to the problem we're talking about. What's your verdict on it?
Yeah, I mean, I agree with Seth. I mean, largely was a good policy, but I think it's just like trying to prepare soup, and the only thing you think is needed is salt. You can't take that soup, right? You can't. So you are looking at the entire value chain, and I don't think that we also said it at the beginning, that Evans, it cannot be the case that every district must have a factory, right? Okay, and that alone may not solve the problem because you see, it cannot be left to the government alone to pick entrepreneurs. You want to first lay a certain baseline foundation that enables the market to function, enables manufacturers to function. But Evans, let's go into the specifics. How many of those 1D, 1F are actually working right now and operating at full capacity? And if they were working, it should show in the data. Let's demonstrate with data that these are the factories that have benefited from this. This is the level of production before. This is the level of production now. This is the impact in the markets. It's the same thing. Go to planting for food and jobs. The question will be, where is the food? Where are the jobs? Okay, so you have in the midst of all of this, you have a macroeconomic environment, an interest rate regime that does not support production. Look, Evans is very basic. If you ask an entrepreneur to go and borrow at 35%, then he will borrow just enough to go and fail. It's as simple as that. Okay, what kind of business production can you set up? We know, Evans, that there are manufacturing companies in this country that actually import finished product and put a local logo on it. Yeah. Because when they set up the production function here, they cannot be competitive. There are companies that are actually manufacturing here. They actually import the raw materials. Okay, we are not only just importing finished products, we are importing raw materials. if you, as Seth said, if you link your agriculture to industrialization and the rest of them, you actually be solving, I mean, even your local food inflation. Evans, as we speak right now, local food inflation is higher than imported food inflation. And you're asking yourself, if you locate one factory in this district, another here, what is the value chain, the linkages? Poor roads. There are no roads in Ghana. The roads they say we have constructed, where are they? You have to see our roads in a textbook. They are not out there. If you have to go to central region and bring raw materials to Accra, that would be all that you do for the day. 8 hours. How would you be competitive with this? Okay, so this is not rocket science. Is that okay? This is how we have managed our affairs over the years, and we steadily expect a different outcome. Genuinely, some efforts are being made, but I can assure you that is not just not enough. And that is where we find ourselves. Look at exchange rates. It's not only that it's affect imported items, the companies that import raw materials as a fee, it also affects them. That is not the only thing. Look at the interest rate we are operating. Compare that to the level of interest rate in Cote d'Ivoire and other countries. How do you expect firms here to be competitive and the rest of them? And I'm going to come back to the import restricted bill.
Yeah, and I need to ask you that because that's my next question. What do you make of that as a solution to the problem?
I didn't support it. One, it should not be the military to select who and who can do imports. That's wrong. And then also the communication of the policy is very important. Right? So there has to be a clear policy direction. And you actually start from somewhere. We didn't start from somewhere and we wanted to start restricting import. What is the motive? That's not going to work. That's not going to work. And that's why we didn't support it. It was not just to ban those imports. The ministry will now determine who and who will qualify to import them. The motive, really, you can suspect it and all of that. So do things in a more transparent manner and the rest, and then start from somewhere. Look, if you lay the foundation, entrepreneurs are wise enough, importers are wise enough to know where to import from. It's not for the state to determine where actually you should. Otherwise, we are not in a market-based economy. Okay? It's not the state to determine which one that you have to get. Well, of course, some level of state intervention is important, but baseline, create that enabling environment. Look, when we talk about enabling environment, it's not just interest rates coming down. We are talking about a level of interest rates at around 8% or below with a maturity of more than 15 years. That's the only thing that can support manufacturing. If you survey the type of lending in our market, it doesn't support production. It only supports imports. Okay, our financial system is designed in such a way that it favors import rather than production and agriculture. You check the data from Bank of Ghana, the level of lending to private sector, and look at the disaggregation. What goes to manufacturing, what goes to agriculture, and what goes to import, and the rest of them. You see where the direction is. That is how we have fashioned the economy. So the financial system itself, the financial market itself, does not align itself to production, to agriculture, to manufacturing. It aligns itself more to imports. So if you're an importer, you are more attractive. And then again, look at the prudential regulations. Evans, if a bank lends to a company in the agriculture sector, right, the risk cover that you need to provide is very high as compared to lending to Ghana government in terms of treasury bill or bonds. Because if you give your money to Ghana government, it's risk rated at 0. If you lend to agriculture, look at the risk weight. If you lend to manufacturing, look at the risk weight and the rest. So I think it's about sitting through and look at the entire value chain and see how we move all of this together.
You raise an important point I want to put to Sechimakwa, but Seth, what's your comment on that? That the financial sector is actually structured to favor importers more than those of you who produce locally. What's your comment on that?
Oh, that is very true, and it's been one of our cries over the years. The reason is that when it comes to borrowing for manufacturing and industry, you don't just rely on short-term facilities. You need medium to long-term facilities. If you are expanding your factory, you are importing machinery, which the importation and installation alone will take you more than 6 months. You cannot take a short-term facility to do so. But go to our banks today, a lot of the funds we are borrowing, we can only get it as short-term facility. We don't get medium to long-term facility. The second aspect is the cost of the funds itself. And the cost of the funds, several factors contribute to that, including the high borrowing from government itself through the treasury bill rate. So if you are borrowing at a high cost of 30%, plus, how can you do medium to long-term business with such a high level of interest cost? So really, the structure of our financial system is not supporting manufacturing, it's more supporting trading. So you need special kind of financial arrangement, equity financing and investment funds that are medium to long term. The other aspect is that for importation, it's relatively easier because when you import, you can even get suppliers credit. And the system works in a way that sometimes the goods even get to the port before you pay for it. So when the goods is already at the port, going to a bank and arranging overspiral facility is relatively easier. So importation is much easier and our financial system supports it. So you need to restructure the whole financial administration and create special funding for industrial development. Otherwise, you cannot develop. If you all compete on the same level for funds, for development, or for business, naturally the traders will get more than manufacturers. So that is true. And I think if you want to really change the paradigm and change the structure of our economy, then we really need to look at this financial arrangement for manufacturing.
Yeah,
the kind of financing you have here cannot do it.
And Yusuf, a final word to you on this. As far as you're concerned, your party is a government in waiting. What's your proposal to fixing this particular challenge, addressing this trade vulnerability, which is highlighted in this report, that, again, would fundamentally change the structure of the economy?
Yes, so first of all, I want to state clearly that I disagree with those who said that the 1D, 1F project is a well thought through project. What is it about that is well thought through when you cannot implement it? The idea was that you were going to create factories in each of the number of districts that we had at that time. Today, as I speak to you, you have the so-called factories concentrated in the Greater Accra region, in the Central region, and in some cases, Central region. So all other regions have been left out. So if it was a well-thought-through project, I don't think its implementation would have become very difficult. In any case, today, the 1D, 1F that we see are existing factories that were even supported under the NDC administration.
So give me your alternative then. Give me your alternative.
The alternative is that we need to identify our comparative advantages. You and I will agree if we are concentrated on working on producing rice, today we would have gotten a good story to tell. What the NDC government will do is to select some of these products, some of these crops, and concentrate on them. We're not going to just say that we are going to establish factories in every district. If we were to do that, it is possible for you to find out 2, 3 districts around one area where you can have one regular, sustainable raw material, and then you can now set up a factory to concentrate on that. And not to say that you're going to set up factories in every district, okay? If we were to concentrate on ensuring that we are able to produce a lot of, let's say, poultry in the Buna and Hafo regions, today would have been reducing our import base when it comes to poultry. If we were to say that, look, we will revamp the Komenda Sugar Factory, and we had earmarked going to the northern sector around Sebulugu to establish another sugar factory. If we were to do that, concentrate our effort in doing that, today would have been reducing import of sugar. And that is exactly what the NDC government wants to do.
Okay. Let me quickly end with the Ghana Statistical Service Director of Communications, who is with us. And Mr. Keja, quickly, when you did this work, I wonder, part of this is to obviously help in shaping government policy. From what you've seen in the data, what are the key lessons there going forward for any government indeed, taking that document of yours? What are the key lessons that from the Statistical Service policymakers should pay attention to?
Thank you, Evans. One key thing that comes up as far as this work is concerned is to diversify, and I think it's come up a number of times. And so, as was indicated in the report, you notice that we are vulnerable in the sense that we have only few commodities that we are relying on, and we have fewer countries that we are exporting to compared to those that we are importing from. And so if we need to make any effort in terms of changing the narrative, then I think that we need to focus more on the diversification as has come up a number of times. We noticed that we always will export raw materials, and this is not something new. And so if we can help our producers to add value to the raw material that we export, I think that it will help better the decision that we take. And also, I think that one thing that as a country we are not doing well is not making use of the statistics that are available. So talking about evidence-based decision making. Now the 1D, 1F that you talked about, we have ended the phase 1, and we have started, I'm sure, the phase 2. The question will be whether we properly assess our performance in phase 1, and whether we are taking on certain lessons going into the implementation of phase 2. And so we noticed that a lot of times our decisions are not based on evidence, and that is also not
and I need to ask you just before we wrap up, from a statistical service point of view, how does it feel knowing that you put out this great work that has great data to influence policy, but year on year, year after year, nobody's touching it in terms of its direct linkage between the data you give us and the policy implementation? How does it feel?
No, it is used, except that the extent of usage is what our concern is. And so that is why we at the statistical service have, are getting closer to the MDAs to make sure that we improve on the use of our data, to make sure that whatever decisions we make at those levels will be based on evidence.
Evidence, okay. And thank you very much. That's Dr. Wusu Kejade is with the Ghana Statistical Service. Listen, enjoy the rest of your evening. This is a conversation that we'll have to return to, especially one that cedi depreciation. We need to have more of this to explore the solutions to the problem of the cedi depreciation, which is really a recurring problem indeed. And the fundamental problems have been diagnosed. The solutions we know. There's a key question of when do we implement them. Enjoy the rest of your evening.